This is the Retirement Planning University podcast with Jordan Schwartz and Phillis Pulvinas.
Welcome to the Retirement Planning University podcast. I am your host, Jordan Schwartz, and today I am joined by my co-host, Phillis. How are you doing today?
I'm doing fantastic, Jordan. How about you?
I'm doing great. It's hot here in Texas, but I like the heat. Really exciting topic for today. We are going to jump in to talk about how a 401k works, when it could make sense, when it doesn't make sense, how to treat it. And before we jump in, Phyllis, I want to mention this to our audience. Please don't interpret this as specific advice or guidance. Everyone's goals are unique and different. So you want to consult with an advisor before really making any decisions with your plan.
Yes, I always say everybody has their own financial DNA. So that's really good advice right there.
Totally. Maybe one of the first things we could start with is just going into how a 401k works. What happens for most folks, you work with your employer and they do a payroll deduction, putting some of that money into what they call as an employer-sponsored plan, where you contribute and save to that. And the goal is you do a good job, save early, save a lot, invest wisely. By the time you're retired, that's a large staple of your retirement income in the future.
Yeah, it's really great in the sense that it's automatic. You don't have to think about it. You make the decision to do it and it's on autopilot. And especially for young people, I think it's a great thing.
Totally. To me, I always look at what's easy gets done, where the way I treat it is, let's say you've never put into a 401k before, or you are putting money into a 401k. If the government came out and they charged a new tax for an extra 2% of your income, you'd complain about it, you'd gripe about it, and then you'd pay it. So the way I would treat the 401k is just that. If you haven't started, it would make sense to start it. If you are doing it, try to put more into it if you can.
Absolutely. And there's one piece of advice that I will give that I would say you don't even have to check with your advisor for this. If there is a company match, you're leaving money on the table, you've put in up to the company match.
Totally. So match at least up to the match. So if you're getting a 3% match from your employer, at the very least match up to that, because that's
free money. Giving it away if you don't do that. Absolutely.
Totally. Here's a question then. If someone's out there sitting thinking, when is a 401 good or when does it make sense? Because I think as someone goes through their retirement journey and planning and preparing for it, how they're utilizing the 401k can become a little bit different.
So it's good for automatic savings, building that nest egg, having a bill for yourself, because like you said, it never gets easier. But when you have to pay a bill, you pay all the other bills. Why not pay one for yourself? So absolutely keep raising it. You'll never miss it. And you'll build a nice nest egg. Closer to retirement, there comes a point that maybe you would consider doing other things, having more choices, doing other things with that 401k. Would you agree with that?
Yeah, definitely. One analogy that comes to mind, Phyllis, and I know for clients in our practice, this is something that we talk a lot about, is this idea between active versus dormant monies. Now, if you've never heard of this before, it's very simple. Active money is simple. It's investments and accounts that you're actively contributing to on a regular basis. So like we're talking about, Phil, think the 401ks, 403bs, TSPs, 401a, 457b. But active is something that you're actively and consistently contributing to. So what happens is during periods of market volatility, when the market falls, we're not happy about it, but because we're buying through the ups and downs, we're taking advantage of that volatility. So when the market falls, we're buying more shares for less, which usually helps us recover much faster. Where I think a lot of people get themselves into trouble are the dormant accounts.
Yeah, that's where there comes a point where you've built up that 401k enough that your contributions going in are not enough to offset that big chunk of money that when the market goes down, just goes down. And then you got to wait for it to come back. And that could be a really long time. That's the point where you want to reconsider.
So give me an example, Phil, of, because dormant's where no new money's going into the account, or for some, the contributions going into that plan aren't necessarily enough to offset the volatility. So no new money going into the plan is simple. This could be an old K from a previous employer, maybe a 401k from a previous employer that you rolled over into an IRA, but those accounts are dormant because no new money is going into the account. That's situation one, What you were talking about, Phyllis, was situation number 2. Can you walk our listener through how that works?
Yeah, absolutely. Because this is a big takeaway. So many people are not aware of this. What I'm talking about is when you've contributed over the years, you've built up a big bulk of money in that account, that lump sum, and your contributions going into it are not at least 10% of the balance of that account. In that case, I would say, that big chunk of money is dormant, not enough to offset the volatility. Now, having said that, I'm not telling somebody, in my humble opinion, not to continue to contribute to the 4K, but to do something different with that big chunk of money. And here's some good news. I don't know, maybe 95% of the time, if you're over 59 and a half, you're able to move that big chunk of money out of there and still continue to contribute to the plan. It's called an in-service rollover. You're still working, you're still contributing, you're still getting the match, but that big chunk of money, I would say you get it out of harm's way because you can move it over outside to your own IRA and have the whole universe of investment options and vehicles that are probably more in line with your risk tolerance at this, because the drawback of that 401k is, number one, you're just riding the waves of the volatility without anything to offset it. Number two, you have limited options. Why don't you talk about the limited options in those 401ks?
For someone who's younger, the limited options aren't bad because the limited options are typically almost always you have stock funds, bond funds, and cash. Now, for someone who's in their 20s, 30s, early 40s, your job is simple. Build a pile of money as big as you can. Well, the best way to do that is to be risky in the market and take that risk.
I would agree with that.
But in your case, Phil, what you're talking about is that when someone starts getting closer to retirement, those once advantageous options, so to speak, the investor starts to outgrow those options, in that the money market, stable value cash, is probably going to lose money to inflation. The bond funds have sensitivities to interest rate risks. They also have some systematic stock market risk where they go up and down, just up and down less than the stocks. And then the third option are stocks. And everyone needs some stock exposure in their portfolio. But what happens is someone gets closer to retirement, those limited options, which were once perfect for the phase in life someone was in, they've started to outgrow that strategy.
That's exactly correct. You need to add other asset classes to your portfolio, especially if that is the largest piece of your investment portfolio. You have to have more asset allocation. That's the key to success for someone within 10 years of retirement, and certainly someone who's retired. That diversification of asset classes, not just a lot of stocks, not just a lot of bonds, but a lot of different classes, assets that move in different directions during different market events.
What would some of those be as an example for someone who's maybe hearing that for the first time?
The right types of annuities in some cases, and I know that oftentimes that makes somebody cringe. I don't like a lot of annuities, but some of them you should be open-minded to looking at. Commodities, I like to do that through exchange-traded funds. Preferred stocks.
Maybe you could use real estate, precious metals. There's a ton of different investments. But when Phyllis is talking about an asset class, a stock is an asset class, a bond is an asset class, real estate, annuities, commodities, those are all asset classes. So what happens is someone starts getting closer for retirement, the limitations of those plans, not having all of those asset classes, instead of helping the investor, which it did probably for the last 30 years, when you start getting into your mid 50s, early 60s, and after, that lack of options starts to become an Achilles heel for that portfolio, for those investments.
That's exactly right.
But one other thing too, and I hear a lot of people talking about this, is they say, what about these target date funds or age-based funds? Because they tell me the closer I get to retirement, the more conservative that I get. It's not entirely accurate, is it?
That's going to get me heated up because
Let's get you heated up.
All that is a different way to package up the age-old rule that, by the way, last year had the worst year in history of stocks and bonds. Just diversify with stocks and bonds. Stocks have more risk. Bonds a safe haven. That doesn't work, and that's all that is. The only safety valve are ones which are not all the way safe. Okay. If you don't have quite as much risk as you do in stocks, you have more in internal fees, trading costs, and things of that nature. Yeah, I'm not a big fan of those target date funds. Now, again, when you're younger and you're just building up and those are the only options that you have, okay, maybe. But as you are older and you've accumulated more, that's not going to be the answer. That's not what you should have. Again, in my humble opinion, but ask your advisor.
And those target date funds, I totally agree with you, Phil. Those target date funds are those age-based investments you'll see on your 401k statements, the 2030, the 2035, the 2040 funds. And the theory with those is as you get closer to retirement, you get more conservative. Let's do this for a second. Let's open up those target date funds and look inside, right? The investments within those are a combination between stock funds and bond funds. And the philosophy and the theory of that is as one gets closer to retirement, they move towards more safety. They go from more stock funds into more bond funds. Here's the illusion or the flawed logic with those plans Phyllis is talking about. If you're shifting money from stock funds to bond funds, are you getting more conservative? Yes. But what I find most people's definition of conservative and these funds' definition of conservative, there's a huge disconnect. As an example, last year, look at 2022. It was the worst year in 100 years, the old school 60-40 split between stocks and bonds did. If we look at those target date funds, that's what we're talking about with those investments. So what I see all the time with folks who I'm visiting with and looking at their portfolios is they're in target date funds because that's what either HR or the mainstream news says to do from an investment planning standpoint. But when we look really deep inside those investments, it's not the case. What someone wants and usually the outcome of what they're seeing, typically there's a disconnect. And I think that's why a lot of people have seen over the last 18 to 24 months, their portfolios fall the way that they have because of those target date funds not necessarily performing as how I think some believe them to perform.
Absolutely. And oftentimes they're funds within, they're a fund that has funds of funds inside. So fees laid on fees that are hard to find adds to the portfolio not doing as well as it could or should.
Absolutely. Yeah. Phyllis, speaking of fees, there's a concept that a lot of people talk about in that do professionally managed 401ks make sense? Does it make sense for you to go to whatever 401k administrator you're at? Does it make sense to go to their advisory team and have them charge a fee to manage those 401ks? Can you speak to that for a second?
Yeah, absolutely. Absolutely. In my opinion, no, because what that is a double dip account. So you've got one piece going to this advisor who's managing the mutual funds, which already has a manager. So fee upon fee. And when a mutual fund, really that outside advisor doesn't know everything going on in that mutual fund. So what advice are they really giving you other than maybe a little bit of rebalance between stocks and bonds? And that's something pretty easy to do. Some little research, do it on your own. I can't see where that's a win in any way.
Yeah, so definitely when you look at a professionally managed 401k, it sounds like what you're saying, Phyllis, is those, if you go to a big institution, those don't often, the value for what you're paying for isn't necessarily proportional to what you're getting. But maybe in some instances, having someone help you with the investments, the tools, the strategies, maybe course correcting, that can make sense. But the professionally managed 401k, it's not that it's bad, it's just it's hard oftentimes to justify the value someone is getting relative to what is actually in those plans.
Yeah, I mean, if there were more choices and things of that nature outside of that menu of limited options in the 401k, maybe, or if they could really drill down on what's inside of those. But yeah, I think it's limited. I really do. I think that as people get closer to retirement, they should have professional management, but not just for the investing aspect of it. That's a piece of it, getting the right asset allocation, not just stocks and bonds and cash. But all the holistic planning that goes along with it. So paying extra money to have it professionally managed doesn't add to that at all. And fees add up over time, big time.
Totally. That makes a lot of sense. So from a planning standpoint, then, if someone is trying to make decisions on their investment portfolio, or they're trying to figure out, okay, how do I treat this investment? Let's say someone doesn't have the opportunity for an in-service rollover, or they want to leave those monies where it's at. How would someone treat the new monies going into the 401k versus the existing monies going into the 401k? Is there a difference?
Yeah, absolutely. So you're talking about somebody close to retirement, right?
Yes.
Specific situation. Everybody needs some growth money. The new money going into it that is constantly going in, dollar cost averaging, going in through the highs and the lows, would be the more aggressive part of the portfolio. That's been built up, I would really lower the risk. Maybe there's a stable fund, maybe there's some short-term bonds. But really look to lessen that risk, because again, you're going to really get beat up if the market goes down with no recourse. So the new money going in, let's be aggressive. Let's ride through the highs and the lows. Over the long term, you'll have more shares that will come back faster. And the money that I would say is like a sitting duck. Let's try to be as conservative as we can within your options. So the right advisor, if you don't have the option to move that money, is really going to help you drill down on that and help you get that safest allocation within the.
So for someone who's younger, this wouldn't necessarily apply as much, because both the new monies going into the plan as well as the existing monies should probably be more aggressive. Whereas what you're saying is someone who's nearing retirement, let's say within 10 years, there needs to be a distinction between how you're treating the new monies going into the plan as well as the existing monies that are currently inside that plan or that 401k.
Absolutely. There needs to be that dichotomy, because once you've built up that money, you might, if the market goes down and stays down for a long time, you don't have enough time to recover and recoup. Whereas the new money going in, it's not all that much, and it may help you offset those losses.
So that new money going into the part of the portfolio, that's where someone can start to be more aggressive and take advantage of the market volatility. Whereas the other monies, that's where we would want to be more conservative. We'd want to be more stable. That makes a ton of sense.
I also want to add this part to it. The Roth 401k option, I really am surprised with how many people are unaware that even exists. People, hands down, taxes are going to go up in the future. I believe that with everything in me. So young people, hands down, pay your taxes now. Pay it on the seed, but not the harvest later on. And even people who are close to retirement want to really take a look at doing some of that Roth 401k option. If not completely, at least to some extent, to build up some tax-free money versus tax-deferred, which is going to be a bomb later on.
So the tax-deferred, basically what's happening is you're getting the payroll deduction, and then you're paying taxes in the future when you withdraw from it, which we think is probably going to be a higher rate in the future. Whereas the Roth, you're basically paying the taxes now, but that money grows tax-free and you withdraw it tax-free in the future.
Yeah, that's just huge. That really is something, because I don't know anybody that I talk to who really believes, with all the money that we in our country, that taxes aren't going to go way up, especially when we take a look at the historic rates of taxation. With that being said, that puts a lot of money in your pocket if you don't have to worry about that.
Totally. So maybe one way we could summarize this, because we've gone through a lot, is if you're younger, your job is simple. Build the pile of money as big as you can. Don't pay attention to market volatility. It benefits you over time. It doesn't hurt you.
That's
For
right.
someone who's nearing retirement, we'd want to see them be more conservative with the existing monies in the plan, more than likely. Or if they have that in-service rollover, exploring to see if that makes sense. but still making sure the new monies going into the plan do carry some risk so they can take advantage of that market volatility. And above all else, if you can, try to do it Roth if it makes sense for your unique and specific situation.
Said exactly.
Cool. Phil, I think we'll wrap it at that. I'll talk to you soon.
Take care.
You've been listening to the RPU Podcast with Jordan Schwartz and Phillis Polvinas.